We're going to have two papers giving different perspectives on bank heterogeneity. And the first one is by Joël Marbet and co-authors, 25 minutes.
Thank you very much, Luis. Okay, I just made the pointer. Thank you. So this is titled The Heterogeneous Bank Lending Channel of Monetary Policies, joint work with Jorge Abad, Salomón García-Villegas, and Galo Nuño, who are working here with me at the Bank of Spain, and Saki Bigio from UCLA. So there's a very large literature on the transmission. There's a very large literature on the transmission of monetary policy and how it transmits to lending, and in particular how this depends on bank level characteristics. Now, this literature has been mainly empirical and has shown, among other things, that it depends on how much liquid assets these banks hold, on the size of these banks, whether they are very leveraged or not, on their interest rate risk exposure, or also on the loan rate fixation, so whether they issue variable rate or fixed rate loans, which is very close to what we have seen just now. Now, what this empirical literature has in common is that because of the identifying assumptions that you have to make, typically you can only identify like a differential impact, that you can estimate how much more banks with high leverage respond relative to how much banks with low leverage respond, for example. And here is where structural models can kind of complement this empirical work by allowing to recover the effect of heterogeneity on aggregate responses, and also by allowing to implement counterfactual exercises. Our contribution is then as follows. So we develop, or first of all, we document several statistics about euro area banks and how they are heterogeneous in their capital ratios, and also in loan rate fixation, so whether they issue variable rate or fixed rate loans. And then we take this evidence as kind of a guideline for developing a heterogeneous bank model with ex-post heterogeneity in capital ratios as we find it in the data, and also that takes into account that there's this ex-ante heterogeneity in loan rate fixation. To give you a sneak peek of the results, we show that our model can replicate long-run distributional features of euro area banks. So on the one hand, it's consistent with these capital ratios that I mentioned before, but it's also consistent with the distribution of assets, or the size distribution of banks. And then what we show is that the aggregate and the individual impulse response functions to monetary policy shocks indeed do depend on these bank level characteristics in the model, and in particular that there's a stronger, banks that issue fixed rate loans, they respond more strongly to monetary policy shocks than banks that issue variable rate loans. And also banks that have lower capital ratios, so banks that are more leveraged, they respond more strongly to monetary policy shocks in terms of the credit that they grant to households and firms. Now, to tie this to the theme of this conference, which is on financial stability, I will also briefly discuss some implications this model has for financial stability later on in this presentation. Okay. So the first stylized fact that I would like to show you is related to the heterogeneity in bank leverage. I'm showing you here the CET1 capital ratios across European banks. And you can see that there's a substantial dispersion in these capital ratios. So some banks are very close to the minimum capital requirement of 4.5%, while other banks have capital buffers that exceed 25% and are even high, or even higher than that. Now, part of this is due to differences in the buffers that they are required to have, but even if you take this into account, there's still a large dispersion in these capital ratios, or in the buffers that the banks hold. Now, the second stylized fact is related to the loan rate fixation. And what I'm showing you here is the share of variable rate loans that are issued by banks for households in the left panel, and the same for non-financial corporations in the right panel. And you see that there's a substantial difference across countries. Some countries like France, Germany, Belgium or the Netherlands, they have almost no variable rate loans in their portfolio. They mainly issue fixed rate loans. While other countries like Finland or Spain or Portugal, they have substantial shares of variable rate loans in their portfolio. And this does not change very much between households or non-financial corporations. And these patterns are also persistent over time. So this is not just in one particular moment that there's this large heterogeneity in loan rate fixation. Okay, so we have this large heterogeneity in leverage and this heterogeneity in loan rate fixation. And with these things in mind, we now turn to the model setup. And because the banking sector is at the heart of this model, and this will allow you to understand kind of the main mechanisms that were, of how monetary transmission works in this model, I will mainly focus on that part. So in this model, we have a continuum of perfectly competitive banks. These banks hold assets on the both short and long-term assets. On the short-term side, we have reserves that are simply remunerated by the policy rate. On the long term, we can issue risky loans to entrepreneurs in the model. And these loans are either issued with a fixed rate or with a variable rate. And then stochastically mature. So the duration of the loan is determined by how long an entrepreneur needs this for operating its entrepreneurial project. And afterwards, it will. I mean, every period there's a certain probability that this project will end, and this is also when the loan will be repaid, and it will kind of vanish from the balance sheet of the bank. Now, issuing new loans incurs an origination cost, and I will briefly discuss this later on. And this is simply to kind of get some persistence in leverage in this setup. Then on the liability side, we have that these banks are funded through short-term deposits and equity. And what is important to note here is that equity has to be accumulated over time through retained earnings, so there's no equity issuance in this model. Then it captures, we try to capture several aspects of regulation that I already alluded to before. There's, on the one hand, a minimum capital requirement. If banks fail to comply with this minimum requirement, then they are simply shut down and taken control of by the regulator. There's also a buffer requirement. They are in principle can allow or can violate this buffer requirement, but if they do so, they are restricted in their dividend payments, so they cannot pay any dividends. So this gives them an incentive to keep a buffer in excess of the buffer requirement so that they can actually pay dividends. And then there's also a liquidity requirement where the banks are required to hold reserves proportional to the deposits that they have. Now, the problem of a bank is then relatively straightforward. They simply maximize their expected discounted dividend payments. So they need to choose this loan origination, the deposits that they want to hold, issue, the reserves, the dividends, and they do this subject to several constraints, among other things, these bank regulation constraints that I've mentioned before. And what this gives us is a situation where these banks are then exposed heterogeneous in both equity and leverage. And this is arising because of this long-term risky loans. I mean, every period there's some idiosyncratic loan default shocks that have hit these banks differentially, and this is generating part of this heterogeneity in equity and leverage. And then, because there's these fixed rate loans and the variable rate loans, there's also this ex-ante heterogeneity that I mentioned before. And for simplicity, we're going to treat this in a particular way. We're going to consider an economy that only issues, or where banks only issue fixed rate loans. So you can think of Germany or the Netherlands, for example. And you can think of the other economy where they only issue variable rate loans. as an economy such as Finland or maybe Spain or Portugal. Now we then embed this in banking setup into a general equilibrium framework where we have entrepreneurs that demand loans and need to fund their long-term investment projects. And I mean, as I said before, these projects are stochastic in their length. And the entrepreneurs are also going to be sensitive to the loan rates. So they will take into account, especially in the fixed rate case, if interest rates are higher because the central bank recently raised interest rates, then the fixed rate entrepreneurs will take into account that they will have to pay a high interest rate over the whole horizon of the loan. Then there are also households. In the model, they solve a consumption savings problem, and what is important for what we see today, or going to see today, is that they will supply these deposits and also own these banks. And there's a central bank that implements monetary policy by setting the policy rate, and a government that runs a deposit insurance scheme. So, because I'm not going to show you any equations, and I apologize to anyone that likes to see a lot of math in these presentations, I'm going to briefly recap the main frictions that are in this model. So there's deposit insurance and limited liability, which gives banks an incentive to increase or maximize the leverage in the model. And this is simply because, I mean, this is a typical friction that is added to these models, simply because the banks benefit from the upside potential of issuing these loans, but they only have limited downside risk because all they can lose is the equity that they have in these banks. Then on the loan, and the second point here, there's these loan adjustment costs. So every time a bank issues a new loan, they have to pay this adjustment cost. Together with the slow-moving equity that arises from the fact that banks accumulate equity over time through retained earnings, there's also going to be slow-moving leverage. And because we have credit risk in the model, and because of this minimum capital requirements, banks will actually have an incentive to keep a precautionary buffer above the minimum requirement, because this allows them to absorb negative shocks. So this gives rise to these endogenous capital buffers, which are additionally amplified by the slow-moving leverage in the model. And then the main amplification channel works here. I mean, whenever the central bank increases interest rates, so there's this monetary policy shock, then this reduces profits, and we will see this in a second. So this will kind of reduce equity accumulation, and then will also map into lower lending in the medium to longer run. Okay. So in terms of the calibration, this is calibrated to quarterly frequency. We try to be consistent with different euro area bank balance sheet statistics, such as capital ratios and liquid assets and loan maturities. We also try to be consistent with Basel III requirements, given the regulation that we have as part of the model. And we then target the empirical response of loan rates on impact of a monetary policy shock to calibrate some of the responses in the aggregate. What is going to be important for today is that I will present a version of the model, and this is also the version that the Discussant received, where there's a full pass-through of monetary policy shocks to bank liabilities. So, I mean, if the central bank increases interest rates by 1 percentage point, this fully passes through to the deposit rate. This is somewhat counterfactual, but we're working on a version of the model where this is not the case anymore and where we have imperfect pass-through. Okay, so this brings me then to the first result, which is this. I mean, we term this a long-run result because I mean this is a steady-state result in the model. What I'm showing you here is the capital ratio distribution in the model, and you see, as similar to what we had in the data before, there's substantial heterogeneity in these capital ratios. And it's important to note here, this is oftentimes in Thank you. Oftentimes in banking models, the banks have incentives to go all the way to the minimum or the minimum capital requirements. So there's not really any dispersion here, and this is something that is where our model differs from a lot of these other papers. And so let me briefly recap for why the banks have this dispersion. So the first reason is related to the fact that they have incentives to hold a buffer above the minimum requirement so they can absorb these shocks. But then they also have incentives to stay above the buffer requirement because this allows them to pay dividends. And you can see that the banks also have ultimately also have substantial buffers with respect to this buffer requirement. Now, the second result that I would like to show you are these marginal propensities to lend that arise in the model. So their marginal propensity to lend is defined here as the additional amount of lending that a bank does if you give it one additional unit of equity capital. So if you think of a bank here at the 90th percentile, for example, in terms of leverage, if you give this bank 1 unit of additional capital, it will lend 2 units of, make 2 additional units of loans. And you see there's a substantial heterogeneity here in terms of these MPLs, which is related partially to the fact that, I mean, these banks at the higher end of the leverage, they are more constrained, and if you give them equity, this relaxes these constraints more than it does for these less leveraged banks. Which then brings me probably to one of the main results in this paper, and these are the aggregate responses to a monetary policy shock. So what I'm showing you here is a central bank that increases the policy rate at time 0 by 1 percentage point, and this is what you can see in the upper right corner here. And because of what I told you before, because of this perfect pass-through to deposit rates, the impulse response function for deposit rates actually looks exactly the same. So they have also the 1 percentage point increase there. Now, if we just focus on how interest rates are affected in the model in response to this monetary policy shock, you see that the pass-through to the loan rates is actually imperfect. So there's a lower pass-through than 1-to-1 to the loan rate. And there's an even lower pass-through if you look at the fixed rate economy, which is the red dashed line. And this has to do with the fact that in the fixed rate economy, I mean, the entrepreneurs take into account that a higher interest rate, I mean, if there's a higher interest rate, they will have to pay this higher interest rate for the whole duration of the loan. So they're a bit more sensitive to loan rate increases, which then means that the banks cannot pass through this policy rate increase as much to these entrepreneurs as they can in the variable rate economy. But I think more importantly is the panel here in the middle, or more important is the panel here in the middle, because here you can, if you think about the balance sheet of one of these banks, on the liability side you have mainly deposits and equity. The return on deposits goes up 1-to-1 with the policy rate. But on the liability, on the asset side, you have loans, newly issued loans, as well as legacy loans. And in the fixed rate economy, these legacy loans have an interest rate that is fixed. So even though the loan rate on new loans increases, the loan rate on loans that have been issued in previous periods stays constant, which then means that the effective loan rate that these banks get actually does not rise very much in response to the monetary policy shock, while there's a full pass-through from the loan rate to this effective loan rate in the variable rate case. Now, what this means is then, again, that there's a much stronger compression in net interest rate margins for fixed rate banks. And this then maps also in several other aspects or several other impulse responses that you can see here. So equity, because I mean net interest rates margins are compressed, profits are going down, and equity falls in both economies, and it falls substantially more in the fixed rate economy because banks have less equity. They also are less able to pay dividends. So some banks will fall below the buffer requirement and will not be able to pay dividends anymore. And even the ones that are above, they will pay less dividends. It also has a negative effect on capital ratios and a negative effect on new lending. And it's always that because there's this stronger contraction in net interest rates margins for these fixed rate banks, that there is a stronger transmission to new lending than for the variable rate banks. Now, I promised you one result, at least related to financial stability, and this has to do with the fact that, I mean, because these capital ratios are eroded in response to this shock, banks are a bit less resilient to future idiosyncratic loan default shocks. Right? So you have actually that the failure probability of these banks goes up as the central bank increases the policy rate. And what's interesting here is that if the policy rate was not increased would not follow this path, as you can see here, but it would have more hump-shaped path, so a more gradual increase over time, the central bank can produce a similar effect on new loans, but it has less of an impact on the failure probability. So the extent of the speed of the interest rate increase actually matters for financial stability here in this model. Now, this is what I wanted to show you. So this brings me to the last result that I wanted to show you, which is the cross-sectional heterogeneity. Because we have this fully heterogeneous bank model, we can not only look at the aggregate responses, but we can also look at the individual responses in this model. And what I'm showing you here is essentially this panel here, only the zeroth period, so an impact of the shock, but across different percentiles of the leverage distribution. And you can see that it's not only that banks that have fixed rate loans transmit monetary policy more to new loans, but there's also banks that have variable rate loans that transmit monetary, banks that have more leverage transmit monetary policy more strongly than banks with less leverage. Okay. So this brings me to my concluding remarks. So we documented some stylized facts about euro area banks, and we use this as kind of guidelines for developing a heterogeneous bank model that can produce this ex-post heterogeneity in capital ratios while taking into account this ex-ante heterogeneity in loan rates fixation. And we use this to study aggregate and individual responses to monetary policy shock and show that there's this stronger contraction if banks issue fixed rate loans, and also if they are more leveraged or have lower capital ratios. And that's it. Thank you very much.
Thank you very much, and thanks for sticking rigorously to time. The discussion will be Federico Puglisi from Banca d'Italia.
Very good. So thank you very much, Luis. Thank you to the Banco de España, to CEMFI for inviting me to and giving me the opportunity to discuss this great paper. Joël did a wonderful job presenting it, so it will make my discussion easier, and also great contributions before, so I'm very happy to be here at this conference. So my name is Federico Puglisi, I'm from the Bank of Italy, which means that the standard disclaimer applies. To go to what is this paper about. So basically, they start from really two empirical observations about bank heterogeneity. The first one is has a long tradition mentioned in the literature, and is the heterogeneity about leverage and regulatory capital ratios. In particular, in this paper, they do show that the distribution of the CET1 ratio is fat-tailed. There is a large tail of high CET1 ratios, and on the other hand, also that there is a lot of heterogeneity in the precautionary buffers that banks keep above and beyond their capital threshold, their regulatory thresholds. The second key heterogeneity that they highlight in the motivating facts is the fact that countries do differ a lot in the loan pricing policies that banks apply. So there is a bunch of countries, mainly normally called the core euro area, let's say, so Germany, France, Belgium, Netherlands, which are characterized mainly by fixed rate loans, and then there is a bunch of countries that are instead mainly characterized by floating rate loans. So the key question that comes natural at this point is there a meaningful and relevant interaction between these two types of heterogeneity which actually shapes the transmission of monetary policy? Okay? And the way they approach this question is by constructing this general equilibrium model where banks are ex-ante identical and exposed heterogeneous, however, in leverage due to various shocks that they have in their balance sheet. They calibrate this to the euro area, and the model comes in two versions. One in which loans are only fixed rate, and one in which loans are only variable rate. And the key exercise will be to compare these two. Joël didn't put any math, so I'm happy to complement at least a little bit to the presentation. I will do some math, but this is probably unflattering to the model, which is much more complex and elegant. In any case, so we have a bank balance sheet. Liabilities are made of deposits and equity. Assets are made of reserves, new loans issued today, and legacy loans. Legacy loans is the stock of loans that I'm bringing from the period before. For simplicity, let's think that all loans mature in 2 periods. So in any given period, I only have the loans that I issued today and the loans that I issued yesterday. The core of the action of the mechanism that is highlighted in the model comes from net profits. So net profits in a floating rate system are going to be given by the interest rate that I gain on new loans, the interest rate that I gain on old loans that is still set in time t, because this is floating rate loans, so I have the ability to adjust them every period, even the loans originated in the previous period. Then I'm earning some interest on the reserves, and then I pay interest on deposits, and I have a convex origination cost. When I move to the fixed rate system, then there is one main difference, which is that now the interest rate I earn on loans depends on whether they're new, then I can set whatever rate I want, or whether they come from a previous period. In that case, I'm fixed to whatever rate I fixed at issuance. Okay? So the stock of loans LT now earns RNT minus 1. Let's assume that there is perfect pass-through from the policy rate to the deposit rate, and let's complete this small sketch with the equity that evolves by accruing profits and regulatory constraints, which implies that loans are a multiple of equity. Okay? And so what is the key mechanism? Why are fixed rates a little bit of a problem here? Well, the key mechanism and the key difference with the floating rate system is as follows. It's exemplified in this chain of events. Policy tightening, we have a policy tightening, the interest on reserves goes up, the interest expense goes up with perfect pass-through, 1-to-1, so the deposit rate goes up. Now the interest earned, on the other hand, doesn't go up 1-to-1, and that's simply because the effective rate that I earn is the weighted average of the rate that I set today on the new loans and the rate that I set yesterday on the originated loans. Why the rate today is free to increase with respect to yesterday, the rate that I fixed yesterday is fixed. And so basically the pass-through to the interest earned on loans is much lower. Very good, thanks. Net interest margin goes down, hence profits go down, equity goes down, and through binding capital constraints, we have new lending going down, okay? So basically now the paper's model is much richer, and we have loan defaults, deposit shocks, and endogenous bank default. Loan defaults will create the ex post heterogeneity in leverage. And the key takeaway picture that I take from this key contribution is really this interaction between loan default, between leverage heterogeneity and fixed versus floating rate systems, okay? And you can see that there is a clear non-linearity in the way new loans contract to a tightening of monetary policy when we are in a fixed rate system. They contract by much more. Look at the last orange bar when we are in a fixed rate and the bank is highly leveraged with respect to when we are in a floating rate system, okay? Now, my comments will be mainly 3 comments, and then I'll have some more, but in the interest of time, those are homework for the authors, and I'm happy to discuss offline, of course. So the first one will be about the contribution with respect to other models with heterogeneous banks. Then I will be touching upon the deposit stickiness, then the floating rate channel, and as I said, more for the authors. First of all, so there is models out there already about heterogeneous banks and about how this interacts with the bank lending channel. So there is this Wang et al., which is a structural banking model in partial equilibrium, where they have all these different channels: reserve requirements, capital regulation, market power, and they quantify those. Then there is Corby and Erasmo, so they have idiosyncratic funding shocks, aggregate shocks to the fraction of performing loans. This is also related to the banking channel. Then there is Belli-Femine and Rassam is here, which is a G dynamic macro model with various types of risks that again is again touch upon the bank lending channel. And finally, we have Mendicino et al. Caterina is also here, where ex post heterogeneity in risk exposure and default outcomes are interrelated, and they create non-linearities in macroeconomic outcomes. So my question, so the paper really contributes. There is one thing that is clear, modeling-wise: legacy loans are introduced. There is a whole bunch, there is a state variable that runs around, which is the stock of loans. And this is very important for the average pass-through of the effective loan rate, in creating stickiness in the pass-through of the effective loan rate. However, it would be nice to have more guidance on the novelties, on the other novelties of the paper, and also more discussion of the role and purpose of the model, and also, is it safe, leading from number 1, is it safe to actually abstract from market power? The second one is about deposit stickiness. So Joël did a great work, so I'm gonna go really fast on this. The pass-through to the loan interest rate is much lower than 1. The pass-through to the deposit rate is exactly 1-to-1, which means that net interest income is always decreasing. Now, this is a problem in the sense that this might be a problem, but it's going to be fixed, so I'm not going to be talking too much about it. Sticky deposit betas, so we might have to have a lower pass-through. However, there is another problem, that is that actually the deposit franchise should at least help a little bit hedge in interest rate risk. Now, we had 2 contributions about it before, so we'll have to think about that. But what they show is that NIM doesn't respond too much to monetary policy. What am I doing here? Well, I will try to provide some help. I have a new paper where we actually show that NIM response is on average 0, but if you look at some samples and different interest rate regimes, it's actually very positive and significant in low interest rate regimes and negative in high interest rate regimes, okay? And there is also this other paper about convexity in the deposit betas. So it might be useful to add these 2 additional environments, low and high deposit betas. Finally, floating rate channel. This goes a little bit, is an alternative to your channel in the sense that we have a monetary policy tightening. Defaults of floating rate are actually increasing much more, which means equity goes down, binding capital constraint, new lending goes down. So there is literature about it on the bank side and corporate side. This is a potentially competing mechanism in your model, potentially important to be included. And one way could be to adjust the velocity check module so that you can actually calibrate it to the 2 versions of the model. And yeah, overall, very interesting paper. It's very topical. As we see, there is a huge heterogeneity in fixed rate and floating loan rates. It is non-trivial and important effects on the bank lending channel and monetary policy, so I look forward to the next developments. Thank you very much.
Thanks very much, Federico. Would you like a minute to react to?
Yeah. I mean, first of all, thank you very much, Federico, for this excellent discussion. I mean, these points are very well taken. And regarding the market power, this is something that we were thinking about. One reason why we have not included it yet, it was kind of for computational reason, because it makes it more difficult to solve the model then. But I mean, if there's, yeah, we will definitely continue to think about whether this is something that we can incorporate into this setup. Then regarding the deposit betas, this is something that we are trying to improve, and we have kind of a very preliminary results on this, but I didn't want to include this today because we haven't fully converged on what we would like, I mean, the calibration and everything that we would like to achieve. And then in terms of the floating rate channel, this is also a very good point that might be something that we should incorporate in a future version of the model. Yeah.
All right, we have time for a couple of questions from the floor. Please. Can you hear?
It's not working.
Not really. Yeah.
Carlos Pérez, financial safety department from Banco de España. So you have motivated the paper on the distribution of capital across European banks. This depends on many factors, many more than would be tractable to include the size, larger banks, or rather smaller banks may be more prone to confidence shocks, and then they need more capital, or banks are exposed to different sectors. But yet with, okay, let's try this. With the model, I understand that you're still able to replicate well this distribution, even though you don't have all these factors. No? So maybe you can elaborate a bit more on the calibration, how you fit that. And the other point is that when looking to monetary policy transmission, it's important also the impact on public debt, no? And the possibility and the incentives that banks have to invest in securities, in particular public debt, fixed income. Do you think that it could be tractable or interesting to include that in further iterations of the model, or rather it makes it too cumbersome? Thanks.
Okay, thank you. So, yeah, regarding the first fact, it's true that there are a lot of other reasons for why these banks hold these substantial capital buffers, and part of them is due to regulation, and as you mentioned. But even if you take this out of this figure, I mean, I have in the appendix, I have a figure that only shows the buffer. Then you still have substantial heterogeneity there, and so. Ultimately, we didn't have to do anything special in the calibration to be able to match this remaining heterogeneity that is there. Then regarding the public debt, so in a sense, you can take probably, I mean, the way we calibrate the model, the reserves, we interpret them actually a bit more general, that this can also be, I mean, part of this is also government debt that these banks hold. So, I mean, in a sense, this is already there. I did not exactly understand what the mechanism that you had in mind that would be interesting for what we're trying to do, but yeah, maybe this is something that we can discuss later on in more detail.
Very good. Thank you very much. We're going to have to move on to the second paper by Alonso Villacorta from UC Santa Cruz and co-authors on unobserved heterogeneity in the bank lending channel.
Can I get that? Okay.
Let me put it up for you.
Thank you. So first of all, let me say thank you very much to the organizer for including our paper in this great conference. It's a pleasure to be here. Presenting this paper, which is co-authored with Bryan, who is at the University of Minnesota, and Lucciano, who is at the Bank of Chile. Now, in this paper, we study empirically the bank lending channel, which we're going to refer to as this mechanism by which shocks to banks, shocks to their balance sheets or to their cost of funding, end up being transmitted to firms. And in particular, we want to emphasize an heterogeneity in this transmission across firms. Okay. So our paper is motivated in the following key question for the macrofinance literature, which is how important are credit supply shocks for firm outcomes. Empirically, answering this question is hard because when we observe credit fluctuations, this could be driven either by credit supply factors or demand factors. Disentangling supply from demand is challenging. So state-of-the-art methodologies now exploit credit registry data, where we can exploit this multiple connection feature from the data. We observe banks lending to multiple firms, firm borrowing from multiple banks, and that's going to help us disentangling supply from demand. Right? So the typical intuition is if I observe a firm borrowing from two banks, and the firm borrows less from bank one but not from bank two, and I think something bad is happening to bank one, it's credit supply, cannot be credit demand because otherwise I would observe that the firm borrowing less from both banks. Right? So a seminal contribution exploiting this idea is Quashamian, but there have been many influential papers using data from the Banco de España as well, following this type of approach. Now, most of this paper follows these key identification assumptions of an homogeneous transmission of credit shocks. However, in certain contexts, we could expect the transmission to be heterogeneous. Okay? For instance, if it exists interactions between banks and firm factors, that I think could naturally arise if we think about bank specialization. There is a recent paper by Paravicino and co-authors using data in Peru that show that there exists a specialization by export destination markets. So it's a bank in Peru that specializes in lending to firms that export to Europe, and another bank that specializes in lending to firms that export to the US. And when something happens to these banks are going to treat differently the firms depending on what they're exporting to. Another example is this paper by Billikel and co-authors that show that there exists a specialization by industries in US banks. Okay, and there are other examples about bank specialization. We could think that the specialization works in other margins, and maybe some of these margins are unobserved to the econometrician. Maybe it's about theories of relationship lending, that banks create relationships with certain firms, then we should expect them they're going to treat them differently. If there is, maybe it's about firm productivity or the type of contracts that are used. Okay? So in this paper, we're going to ask how important are these bank-firm interactions for the transmissions of credit shocks? And if these interactions exist, then what can we do to answer these important questions of the importance of credit supply shock for firm outcomes? So to think about these questions, in this paper, we develop a methodology that estimates the impact of credit shocks, allowing for bank-firm interactions, allowing for this heterogeneous transmission. Our main assumption will be that the effect of credit shocks can vary across firms, but across different groups of firms. And we're going to treat this group of firms as unobserved, and instead we're going to identify them through machine learning techniques. So this method will be valuable, for instance, for researchers when they are uncertain about the specific dimension of specialization that is relevant. Or maybe they have a sense of what is the margin that matters, but they lack access to the data. Still, our methodology would apply. We're going to apply our methodology to Peruvian data. We have access to the Peruvian credit registry. We document in our data set that there exists significant evidence of heterogeneity in the transmissions of shocks. Once we learn about this heterogeneity, we conduct different applications which highlight the importance of learning about heterogeneity in order to learn well about the importance of the bank lending channel. Okay, and I hopefully I have time to go through all of them. So in the literature, this literature that estimates the bank lending channel is extensive with many important contributions. Let me highlight in the second bullet some recent papers that highlight this heterogeneity in the transmission as well, but by looking at observable characteristics. So I told you about Paravicini and co-authors that look at export destination markets. There is another paper by Bashina and co-authors that show that there is heterogeneity in the transmission depending on the contract, the type of contract is used. Instead, we're thinking about unobserved heterogeneity. What if we are not sure about what's a relevant margin or multiple margins? So we're going to instead rely on the econometrics literature to try to identify this heterogeneity. So First, I'm going to give you a quick review of this standard framework that relies on the homogeneous transmission of shocks. Then just directly by looking at the data, I'm going to show you some evidence of heterogeneity in the data set. And then I'm going to go to a full model with interactions and then show you the results. So let me start with this standard framework that assumes homogeneity in the transmission. So let this YFB be the growth rate of loans between a bank B and a firm F. Typically, the literature assumes a linear specification that looks like the following. So a lending from bank B to firm F can depend on alpha F, which capture firm-specific factors, typically interpreted as credit demand factors. Beta B, which capture bank-specific factors, typically interpreted as credit supply factors. And then any interaction between banks and firm, any factor varying at the bank-firm level, is going to be captured by this epsilon. Note, of course, that we observe the lending of bank B on firm F if it's in our data set. We call that if a connection exists, and we call that with D equal 1. Now, typically, the literature, or many papers in the literature, rely on an observed measure that is associated with a credit supply factor. So in this case, instead of treating beta B as an unobserved factor, we're going to have an observed variation XB. For instance, in the seminal paper of Kwashamian, this is exposure of banks to a liquidity shock. And in that case, we're interested in the treatment effect, which is the parameter theta, right? How exposed banks end up transmitting that shock to the lending to firms. Now, in any case, either we are thinking of beta as an observed factor or interested in this observed treatment effect. This model would rely on the following assumptions. First, the one of homogeneous effects, which is that these bank shocks, beta B, are transmitted equally to all the connected firms. Firm shocks, alpha F, are transmitted equally to all the connected banks. Right? So that's embedded in the linear specification. Moreover, we would need what we call an exogenous network assumption, which is that these interactions captured by epsilon have to be idiosyncratic. Okay? Meaning that they cannot be correlated with our demand or supply factors, nor with the network connections. Okay? So the idea is that when I observe a bank lending to a firm, that shouldn't tell me anything about the particular interaction that they have. Okay? That is going to be an important assumption. Moreover, credit registry data typically give us multiple periods of data, so we can add subindex T to all the parameters here, but for simplicity in the presentation, I'm going to drop the T's. How can we estimate this? Well, given multiple connections, we can just estimate this by using fixed effects. What's intuition? For instance, if we want to identify beta B, I could look at the differential borrowing of the same firm F from two banks. Because I'm looking at the same firm, the factor alpha F would disappear because it's homogeneous. Then the lending of bank B relative to B0 to the same firm have to be explained either by the differential credit supply factor beta or the interaction epsilon. Right? But now, given the exogenous network, I can average across a set of firms borrowing from both banks, and that is going to wash out the epsilons. Okay? So that moment condition identifies the parameter of hysteresis, the betas, or in case I'm relying on observed bank exposure, that is going to identify the parameter theta. So what is intuition? All systematic difference in the lending of two banks to the same set of firms is going to be attributed to a credit supply shock. Now, moreover, this moment condition should hold for any common set of firms, right? Because the parameters are homogeneous. So now let me show you this moment condition directly in our data set. So here I'm showing you in the x-axis the 4 main banks in Peru. And I'm just plotting that moment condition, the average differential credit across different banks to the same set of firms, borrowing from the 4 banks. So we can see there, for instance, that Bank 2 lends around 12% less in this particular year relative to Bank 1. So it looks like something bad is happening to Bank 2. It's a negative credit supply shock to Bank 2. Bank 3 and 4, they are showing little shocks. Okay? Now, let me take all of these firms borrowing from the 4 banks and divide them in 2. So now on the right, we have the red firms and the blue firms. And we can see that we already see considerable heterogeneity, right? If we look at Bank 3, we look at the red firms, Bank 3 is lending more than Bank 1, so it looks like something positive is happening to Bank 3. But when we look at the blue firms, we see the opposite. Now, in this case, we made the cut depending on the size of the firms. But we use this as a first evidence that heterogeneity may be present in the data. So then we need to take it into account when we estimate. Okay? So now let me go to the full model with interactions that can account for heterogeneity. So the full model will look like the following. Now we have this factor psi varying at the bank firm level, which now could capture systematic interaction, right? It could be correlated with the factors or with a network of connections. So in order to separate epsilon from psi, we need some structure. So in our preferred specification, we're going to model these interactions or heterogeneity at the group level. The idea is we're going to assume that every firm belongs to a discrete group G, where there are big G number of groups. And now we're going to allow a factor to vary at the bank group level. This would capture, for example, that the bank shock can affect differentially firms in different groups, under the assumption that within the group, then the shock is going to be homogeneous. In the paper, we motivate this empirical model with a theoretical banking model in which there is lending specialization. We show that this type of empirical transmission of shock would arise. And moreover, this is motivated by this empirical evidence, right? So we say that Paravicini and co-authors show that export destination markets are important, so we could define the groups. Firms that export to the US belong to one group. Firms that export to Europe belong to another group. Another example would be using the paper of Villacorta and co-authors. So it's the type of loan what matters. So firms using certain type of loans would belong to one group. Firms using another type of loan belong to a different group. Now, we would now replace this exogenous network assumption with one that works within groups. Okay? The idea is that these epsilons are idiosyncratic. Okay? They cannot be correlated with the network connections. However, the interactions that happen at the group level can be correlated. Okay? So that's important because that will allow now that the probability of matching one, that a bank matches with a certain firm can depend on interaction. The interaction happening at the group level. So our model allows, for instance, that firms that export to the US have a higher likelihood of connecting with banks specialized in the US. And that's something that actually Paravicini and co-authors show that happens in the data. Okay? The standard framework wouldn't allow for that, so I think that's important to highlight. Now, how can we estimate this model? If groups were known, this would be easier, right? So we just use the fixed effect approach, but conditionally on groups. Firms that belong to one group, I do the estimation separately from other firms that belong to different groups, etc. What is the issue? That these groups may be unobserved. Okay? Maybe the data is not available, or maybe the heterogeneity depends on multiple variables, and some of them are unobservable. What is going to be our solution? Well, let's follow recent developments in the econometric literature that allow us to cluster observation and find these groupings. We're going to follow, in particular, this paper by Bonon and Manresa. Now, let me say that typically clustering techniques are based on some observable dissimilarity measure. The idea is that firms that look similar across some observable characteristic, we put them together. In our case, the groups are defined by how banks treat them when they are affected by an unobserved credit shock. Okay? So we're going to combine the ideas from the clustering literature with this bank lending framework. Okay? And the algorithm would look in something like this. Okay? Give me a summary of the algorithm that we use. So we're going to assume that we know the number of groups, big G, and we're going to repeat the exercise for different numbers of groups. We're going to start assuming some group assignments. So let's say that firms belong to group 1, this to group 2, this to group 3. We're going to take this guess as if it was the truth in step 1, and then estimate our factors through the standard approach, conditional by groups. So we're going to have parameters that change at the group level. Then in step 2, we're going to use those parameters to make predictions about what credit growth is supposed to be. The prediction is going to vary depending on the group that the firm belongs to. So now we're going to assign the firms to the group that gives the best prediction. That is going to give us a new grouping. So with that new grouping, we're going to go back to step 1, estimate again, and keep iterating until convergence. Okay? That's the idea. So in the paper, we show the theoretical properties of this estimator. We show that it's consistent if we have enough numbers of firms and banks. Moreover, we conduct many types of simulations to see the performance of our algorithm. And we show that it performs well, even for data sets calibrated to our data set. Okay? So, but let me skip this discussion. And before going to the empirical results, let me do a discussion on interpretation of what we are finding. Okay? So we show theoretically that our algorithm will detect any interaction occurring at the bank firm group level, okay, that is systematic. Now, this is an interaction. So we see that banks treat, or there is this variation in the lending of banks by these groups. But how can we interpret these factors? For instance, we could have a supply interpretation in which this is a shock to bank B that is transmitted heterogeneously to the different groups, but maybe it has also a demanded interpretation. It could be a common shock to the group of firms that they decide to borrow differently from the different banks. Okay, so we cannot escape this issue of interpretation. So first message is, once we think that there is heterogeneity in the data, then you have to be careful of how you interpret your fixed effect approach. So we're gonna explore two potential solutions to this, because our idea is to understand the importance of credit supply factor for firms. So in the first one, we could add an instrument. Okay, so if we rely on a credit supply shifter, observe variation at the level XB, for instance, associated to an event study, as in the case of Kwajalein, then in that case, we could clean all of the part from this beta B at the group level that comes from this credit supply shifter. Okay, the assumption is that the XB is uncorrelated with the bank specific credit demand. Now, one may wonder, okay, if we're relying on a credit supply shifter, then do I have to care about heterogeneity? No? For instance, if I'm just interested in an average credit supply effect, now that I found a credit supply variation, can I just use a standard homogeneous Kwajalein estimator? And in the paper, we show that not in general. Okay? So even if the heterogeneity is our heterogeneity in credit supply, you have to be careful on how you find your average effects. Okay? So if banks and firms were randomly matched to each other, then you can use the standard approach. But if they don't, then that is going to be a bias estimate. Okay? And actually what matters is if the probability of banks of matching with certain firms depends on how banks are going to treat those firms, then that can be problematic. And the problem can be so big that you can get even an estimate with the opposite sign. Okay? But I'm going to defer you to look at the paper to see the details on that. Our second approach to try to, if we don't rely on this credit supply shifter, if we don't have it, we propose an approach that goes directly to a real effect regression. What is the idea? The goal of finding this credit supply factor is to see how important are those for firm outcomes. Okay? So in this real effect regression, we're going to take this credit supply shock and see how important are those, for instance, for firm investment. In that regression, we can control for group fixed effects. What is the idea is that the demand shock that affects the common firms, that is common to the firms in the group, should lead to similar effects on these investments for all firms that work within the group. We can control for that in the real effect regression. Okay? Our assumption is going to be that we could have firms within the group that are differentially exposed to banks. Okay? And then the question could be, why is that if they belong within the group, why are they differentially exposed? So there are different explanations that we provide in the paper, but the point is that's a testable assumption that we can look in the data, and that's what we do. Okay, so I'm going to show you exactly the specification in a few slides. So now let me just jump directly to the results. So we have data from the Peruvian credit registry. So first, let me show you, once we apply our methodology to this credit registry, first, evidence of heterogeneity. Here I'm showing you exactly on the left the same graph that I showed you at the beginning, the 4 main banks of Peru. I'm looking here at differential credit growth across banks, but now for the groups that come out from the algorithm. Okay, so we can see substantial differences, right? These differences are going to be then reflected on the estimates. So on the right, we have the estimates of this beta that vary by groups. So for the red firms or the blue firms, for now, these different groups of firms are defined by the algorithm. Okay? So now once we have learned about this heterogeneity, what can we do? So we conduct 3 different applications. The first one is an event study. Okay. So here we're going to follow this important paper by Paravicini and co-authors, which follow a similar approach to the Kwajalein. The idea is that we have an observable variation measuring a credit supply. In this case, we're measuring the exposure of banks to the crisis. The idea is that we have, in Peru, certain banks that rely more on foreign credit, so we thought that they are going to be more exposed, relative to the banks that rely more on domestic deposit, they're going to be less exposed. And so we want to see how more exposed banks end up lending to firms relative to the less exposed banks. We're interested in the parameter theta. Okay? Now we're saying, we learn about these groupings, so now this treatment effect, how the exposed banks treat differently the firms, may change at the group level. Okay? So now let me show you the result of the estimates of this theta, which vary by banks and groups. Okay, so here we're looking at two different exposed banks. You can see first, in the case of G equal 1, here is assuming that the effect is homogeneous, we have a significant effect. Okay, that's a significant effect. It's small, but it's significant. So exposed banks lend less than non-exposed banks to the same set of firms. But that hides a lot of heterogeneity. Once we go to more groups, we see that, for instance, with G equal 2, there is some group of firms that get destroyed, while other firms are not much affected. And actually, if we go to G equal 4, we can see that there are some group of firms that are protected. Now, it's not that all banks protect the same group of firms. That G equal 4 is protected by the first bank, not by the second exposed bank. So that points to this idea of a specialization, right? So certain banks maybe create relationships with those firms, and they are willing to treat them, but not all banks are going to treat them in the same way. Now, who are these firms? What are behind these groups? So let me just give you a bit of idea. We have some observable characteristics at the firm level that we observe that differentiate the groups. For instance, collateral matters, the size of the debt matters, if the firm exports or not matters. Okay. Let me highlight on G equal 4, for instance, debt size. So we can see that debt size is important. So actually, the firms that are getting destroyed by banks are the ones that have higher debt, okay, relative to the other ones. But now debt size is not the only thing that differentiates the groups, right? So for instance, if we look at the low debt firms, we're going to miss part of heterogeneity. This group of firms that the first bank was protecting are the firms that have low debt, but also have low exports. Okay, so maybe it's a multiple margin of characteristics that are going to help us to understand these ideas behind bank specialization, and our algorithm can help us in detecting those multiple margins. Okay, so as a second application, we go on the real effects. Okay, the idea, again, is that we identify these credit supply shocks. We want to see how important are those for firm outcomes. In this case, we have data on firm investment. Okay. So the first step is to create a credit supply shock at the firm level from the bank shocks. The idea is if a bank is experiencing a certain shock, we're going to assign that a weighted sum of those bank shocks to the firm depending on the importance of the bank for the firm, where the importance is measured by the importance of the bank in the borrowing portfolio of the firm in the previous period. Okay? So once it has this supply factor at the firm level, we want to see how important is that for firm investment. Now again, highlighting the discussion before, it is important to control for firm group effects here. Okay? So the idea is we're looking at firms that belong to the same group. If part of that beta has demand, it should generate a similar effect on investment. So that is going to be controlled by the group fixed effect. Okay? These are the results for the beta 2 estimate. That's an interesting estimator. We can see that the homogeneous estimator is very imprecise, have actually a point estimate that is negative. Okay, it's non-significant. Instead, once we go for the heterogeneity, even starting from G equal 2 up to G equal 5, we find a significant estimate. The point estimate is between 4 and 6%, the elasticity. Okay? And I think these results make sense, at least the fact that the homogeneous estimate is very imprecise, once we have seen all of the heterogeneity in the data set, right? So I told you, there is a bank that lends more to the red firms. We should expect those firms to invest more. But the same bank is lending less to other firms. We should expect those firms to invest less. When we go to this regression and we assume homogeneous effects, we're trying to associate all of these differential investments with the same number, because all of them are connected with the same bank. Once we open for heterogeneity, we say, no, actually the bank is lending more to the red firms, and those firms are investing more, while it's lending less to the blue firms, and firms are investing less. That is going to help finding the right elasticity. Okay, so it's important to consider heterogeneity if we want to find out the real effects, which is important. In the end, the ultimate goal of this exercise. As a last exercise, we go and highlight the importance of the network of connection between banks and firms. The idea here is, if heterogeneity in the transmission is important, then how banks and firms connect to each other may be crucial for the aggregate transmission of a shock. Imagine that the exposed bank is mostly connected with firms for which the transmission is strong. Then we're going to expect a much important transmission on aggregate than if the exposed bank is connected with firms for which the transmission is weak. Okay? So our empirical model allows us to calculate what would happen in a counterfactual in which banks and firms are connected in a different way. So for instance, we look at a random assignment. So we say, if we observe a firm borrowing from 3 banks, we're going to try to say what would happen if that firm was borrowing from any random 3 banks. For any counterfactual connection that we don't observe in the data, what will happen, we're going to use our model. Now, of course, the prediction of the credit growth is going to depend on the match between the bank and that group of firms that we learned already in the data. Okay? So this is the result. This is the random. For the random network of connections, we're going to calculate the aggregate credit growth and compare it to the observed network. So we have that on average, the random network generates 20% less credit growth than the observed network. Okay? That means that banks and firms in the data are creating matches that helps expanding credit growth, okay? So which is good. Now, this is for a particular year. I could go to a year of the crisis and we get the opposite. Actually, it's going to amplify the negative effect. So let me just say, in terms of financial stability, it's important to understand how banks and firms are creating a connection with each other to understand, in the end, how, on aggregate, a certain shock is going to impact the economy. Okay? So I'm going to leave it there. I show you a new method to understand the bank lending channel, considering this heterogeneous effect, and I show you that this is important for different exercises. Thank you.
Thank you very much. The discussion by Víctor Sancibrián from our own CEMFI.
All right. Well, thank you very much to the organizers for inviting me to discuss this paper, which I very much enjoyed reading. So thank you. So I'll start with my own summary of the paper, and then I'll follow with 3 comments, and then conclude with some remarks. So in this paper, the authors are interested in characterizing heterogeneity in transmission of bank credit supply shocks to firms, right? And the starting point here is this seminal contribution by Kwajamian in 2008 that exploits match bank firm credit data and postulates a 2-way fixed effects specification, right? So we have here the long growth rate of firm F with bank B over any 2 periods as explained by firm fixed effects and bank fixed effects. Now, for the 2-way specification to be a reasonable model of average credit growth, well, any systematic component beyond the fixed effects, such as any predictable bank-firm interactions, must be accounted for, right? And the authors emphasize here market specialization by banks. So in order to get around this, one possibility is to group similar firms together and then re-estimate the 2-way model, right? So if we think that bank specialization happens mostly along firm sectors or along export markets, well, we would first group firms by sectors or by export markets, and then we would re-estimate Kwajamian. So to say the same thing with equations, essentially given a rule that assigns firms to groups, this is analogous to specifying this equation that now allows for bank fixed effects to be group specific, right? So here they're indexed by J. And notice that conditional on a given group, then we are back to Kwajamian's setup. So the key empirical innovation in this paper is that the authors allow this grouping to be based on unobservables, right? So that is, they allow group membership to be left unrestricted. And this is in the spirit of k-means or clustering algorithms, right? That sort of group similar firms together into a pre-specified number of groups. Now, in this particular case, the estimator and the statistical properties are developed in this paper by Stefan Bonhomme and Elena Manresa in 2015. Now, the authors bring this to Peruvian matched bank firm data and repeat the analysis for every period in the panel and uncover substantial group level heterogeneity. And importantly, they find that these group effects correlate with certain observables, but that's not the whole story, right? So now, this is the basics, and helps me sort of set the stage for a few comments, but there is, of course, a lot more in the paper, as we've seen. So, for instance, there are results of what happens when we do Kwajamian and we ignore heterogeneity, on estimation with credit supply shocks, on the implications of these interactions for aggregate credit growth, and so on. Okay, so my first comment is a bit technical, but I think it has important implications. So there is these group fixed effects, right? These betas, and they might capture both credit supply shocks from banks to firms, right, which is sort of the direction we're interested in, but also, as you've discussed, demand shocks that might, from groups of firms to banks, that might lead to differential borrowing, right? And when these credit supply shocks are observable, well, a possibility is to just bring them to the equation here, and in this, in this particular case, allowing for group-specific effects, right? But I think that given this emphasis on both credit supply shocks and credit demand shocks, I think there is value in decomposing these group effects more explicitly as the sum of these heterogeneous credit supply shocks, and then any other unspecified interactions that could be these demand shocks, right? Now, I think this is worth for two reasons. First, because it makes explicit that we're allowing for additional factors beyond these supply shocks, which might not be totally obvious if we just look at equation 3. But also because it suggests more robust estimators. Okay, so in particular, given uncorrelatedness between these supply shocks and these demand shocks in the errors or mean independence, then a two-step estimator that basically first obtains these beta hats and then regresses them on the supply shocks will be more robust than one based on this first stage directly. And the reason is that this only requires this mean independence condition, while here above we are also imposing mean independence with respect to the heterogeneous loadings, the heterogeneous coefficients. Okay. Now, my second comment is on quantifying and observed heterogeneity, right? So I think that, given the goals of the paper, it is sort of natural to try to quantify the extent of how much heterogeneity there is. And a very simple summary is given by the variance of these group level coefficients over groups, right? So this is the population variance. We have here the betas, and we have here the type probabilities. So these are the population frequencies of each group. And this is also identified in the same way that the mean is identified, right? So one could calculate this for over groups, but for across banks or across time, or maybe for these betas, but when they're net of certain observables that we can control for, and so on. Now, in terms of estimation, a feasible counterpart could directly use these beta hats and these sample frequencies by fixing these group membership that would also estimate it in the procedure. Now, an open question is whether this is a good estimator. So whether we can construct or we can construct bias-corrected estimators. So the idea here would be that every firm in the same group has the same beta. So those are essentially repeated measurements for the same betas. And those ideas can be exploited to construct bias-corrected estimators. And Arellano Bonham 2012 is a good reference. And then my last comment is about matching of firms and banks. So basically, you could go to the original equation and do this variance decomposition, right? With the variance of the firm effects, the bank effects, and the covariance. And an alternative way to think about the paper is about endogenizing sorting. So the idea here is that while sorting is definitely allowed in the Kwajamian setup, because you could have positive assortative matching, let's say that better firms borrow also from better banks. Here, the paper allows for group-specific sorting, right? So for instance, heterogeneous borrower bank matching patterns along, say, bank specialization. And you could look at this over time. So for instance, you could look at persistence over these sorting statistics as suggestive of endogenous matching based on fundamentals. And again, here, from a methodological point of view, that is also interesting in studying the finite sample biases in these variance components. There is a limited diversification bias, which is sort of totally analogous to the limited mobility bias in the AKM literature. Okay. So I'll just conclude. I think it's a great paper. I think it's a substantial step forward relative to current applied practice, and it uses sort of fancy methods, but they're very much sort of grounded in empirical content, right? They're very much motivated. And the other reason why I think it's a great paper is that it opens the door to several potential extensions and methodological questions, and we've talked about some of them in comments 1, 2, and 3. And let me just wrap up by sort of emphasizing that it is worth keeping in mind the parallel of the data and the methods here with those from the matched employer-employee data literature. And this paper here by Stefan and co-authors is a good reference for recent advances. Thank you.
Thank you very much. Would you like 1 minute to react to the comments?
Sure. Thanks a lot for the discussion and the suggestion. I think they can be very, very useful. So one key point is once you identify this interaction, again, as I was discussing before, is it credit supply, is it credit demand? Once you have the credit supply shifter, you can always project these interactions to the credit supply shifter, and then you have the part of the credit supply and then the rest. That's actually one option that I think we discussed a bit in the paper, how to estimate these heterogeneous treatment effects, these heterogeneous supply effects. But in the end, in application, we use the other more standard approach that you're saying, okay, it's a bit weaker, so we should go with the option. So that's a great comment. On how important is heterogeneity and how we can quantify it, we show in the paper R-squares of how these G's are changing, but I'm going to look at your proposal. That can be nice. And yes, the part of sorting, what you think on heterogeneity, then thinking about how banks and firms are creating connections becomes like something that is key. And it's key for all the literature, and that's going to make us rethought our assumptions. Now here we're thinking if the relevant margin is at this group level and you're able to identify it, then you don't need to worry much about how they are creating it. If you are not identifying that would still be a problem. And we were thinking about some tests that maybe I can discuss with you later to see if you like them or not. But thank you.
We have time for 1 or 2 questions.
I'd like to try to bring more economics to the discussion here. How do we interpret the number? Oh, sorry. How do we interpret the number of groups that you're going to put to examine heterogeneity? What happens if when you have 3 groups, heterogeneity doesn't matter? When you have 4, it does matter? I mean, is there any discipline here? Can we test to which extent the G number is a number that we should stop at a certain level? I mean, again, other than testing the idea that heterogeneity is important or it's not, can you test any other hypothesis here?
Let's take another question, and then we'll reply to all.
So I think it's a very interesting paper, but let me be a bit critical. So first, as the discussant said, you can test, even with multiple groups, you can test whether the covariance, when you leave these fixed effects for the different groups, they are in the error. So you can test whether the covariance and observed covariance between that demand and the supply shocks, they are 0 or no. They can be 0 or they can be with a different sign, as the discussant said. Second thing is, we had a paper a long time ago in Econometrica in which we show different risk-taking motives through the credit supply. So, and this could be unobservable characteristics and unobservable characteristics. Also, the first paper today was talking about risk-taking. Once you have that, you might think that that's a demand issue, but it might be a supply issue on different incentives of risk-taking within the credit supply, and this could be within observable characteristics and unobservable characteristics. And the last point, which I think is missing in your analysis, is that in order to understand better credit supply and credit demand, this is not like the typical thing in econometrics that you have one variable and you can do group fixed effects. You have not only credit volume, but you have non-credit, non-volumes, like pricing, like collateral, like maturity, which are very important to understand credit supply versus demand.
Last question.
Hi. My question / comment will echo what has been said before. Your method seems very complicated, but as an alternative, why not just do old school standard cluster analysis? Because essentially that's what you're doing. You're coming up with some groupings, reduction of a large dimensionality into groups for which we don't really know the label. So we arbitrarily label them with small. The group 1 could be small banks, group 2 large banks, then high capital ratio, low cap. But a cluster analysis in step 1 would do the same thing. It would cluster the cloud of firms into groups that look similar, and then you can run your regression with cluster-specific or group-specific fixed effects. So that would yield very similar results, but would be more simple.
Okay, thanks. 2 minutes. What you can reply to?
Thanks a lot for the question. All very well taken. I mean, those are issues that we are always thinking and see how can we improve on them. So on the number of groups, I mean, our preferred approach is to try to just see how the results change for different numbers of groups. For instance, for the real effects regression, we show from G = 2, we already find an elasticity which is around 5%, and we're still going up, and we find something similar. There is always an issue that as you increase the number of groups, then you're going to have every time less firms inside a group, which is going to affect your power on estimating the effect. So everything works nice theoretically, and we have kind of the theorems to show that it works. But in the end, in the practical case, it's hard. I think that the best approach is just to try different numbers of groups and see the results, see how they change, see how firms start changing the groups, I mean, in terms of the characteristics when the groups are changing. So that's something that we kind of explore in the paper. But I mean, completely well taken that type of concern. It's I mean, it would be, I guess, something that we try to do on the covariance of the effects, like the supply and the demand, and how important that covariance is. We are not computing that, but we could. Something that speaks to that is the last exercise in which we do this counterfactual when we start matching banks and firms differentially. So if the covariance was not important, then that aggregate effect wouldn't be that important. So if banks and firms are not creating connection in a way in which these betas are larger or lower, then that wouldn't be that important. If it does, then it would be important. That's why we kind of a different way of going into, I think, into that direction. But we should be computing those covariances and showing them. Of course, contracts are more than volume. They have maturity, prices, and all of those can help us identifying supply versus demand, and we should be doing that. I think most of the literature relies on just using volume because that was kind of what we have better data. Now I think the new data coming from credit registry have better prices data, and there are some people that are actually going into that direction to try to improve this distinction. So yeah, completely. And on the method of the clusters, I mean, I think what you're saying is let's use the observables to cluster firms across observables, and then see if banks specialize across those clusters or not, right? We're going in the opposite way and say, let's see how banks are treating differently firms, and we're going to create the clusters by looking at how differentially banks are treating different set of firms. And then we can go and look at the observables. And also a big point is that maybe the clusters that matter are not driven by the observables that you have, maybe driven by other things, right? So that would be our.
Thanks very much to everybody. Now, any housekeeping announcements, or we just move on to lunch? Move on to lunch.